What's up guys? So last week we talked about what a fund is. If you haven't seen that video yet, have a watch to understand what they are and how they work. Because today we're going to talk about how to choose a fund. By the end of this video, you're going to understand how to research funds, active versus passive funds, and how to keep costs down when you're choosing your funds. It's a topic that can be very mysterious to people, but today we're going to make it make sense.
Could somebody please make it make sense?
Okay, so what do we look for in a fund? How do we choose one that's good for us? I feel like I'm giving dating advice here and not talking about funds. Welcome to the Fund Connection. So as we saw last week, there's huge variation in funds. There's literally thousands to choose from in the UK alone. And this isn't investing advice, so I can't tell you which specific funds to choose, guys. However, there are some solid principles that I personally follow, which have done well for me in my investing journey through funds over the years. And I'm working off the assumption that we want to balance risk, which, by the way, you cannot avoid when it comes to investing in stocks and shares, whilst also trying to pursue a desirable return. There's always going to be an inherent amount of risk that you can't mitigate and manage away. But you can put in place steps to reduce the amount of risk that you're willing to take. So investing in stocks and shares is a lot like buying a house. Most people want their house to go up in value over time, much like we want the value of our investments to go up over time. But in order for that to happen, we need to make the right choices when we buy to manage the risk of us losing money. Things like buying at the right price, at the right time, in the right quantities, making sure the quality of the asset itself is on point. All of that is very important, guys. The great thing about funds is that they do a lot of this work for you. They provide diversification, minimal effort, and robust returns, generally speaking. Now, this isn't me saying that funds are the way, the truth, and the light when it comes to investing. There are many other investing strategies that work, guys. However, if you're just starting out, if you're new, and you're looking for a strategy that's simple and actionable and generally speaking delivers reliable returns, you may want to consider funds, guys. So you want to begin by researching your funds. As we said earlier, there are tens of thousands of funds in the UK alone, and the question is, how do we pick the right ones for us out of those, right? For me, it's like going to a coffee shop for the first time. I'm not even a coffee drinker, by the way. I think I had my first proper one at 25 years old. And I remember the barista asking me, what would you like? And you stare up at this blackboard and there's a list of mocha this, latte that, espresso this, and I might as well have been reading Egyptian hieroglyphs. I had no idea what all of these things were. Well, starting out in investing is a lot like going to a coffee shop for the first time, guys. It's hard to know where to begin and what the terms that you're looking at even mean. I'd highly recommend a website called Morningstar, which is a free website open to everyday people like you and me, and you can use it really to narrow down a list of, say, 50,000 potential funds down to 3 or 4, right? It's a very helpful resource. Does that sound good so far? Let's carry on. So here's an easy to use formula to research criteria to use if you're starting out and you want a fund that ticks all of your boxes. So first is to choose your category. Now, a category is basically a group of funds which are designed to roughly do the same thing, and there's 4 of them that you need to know about. Now, they're going to sound like jargon as I'm saying them, but don't worry because I'm going to explain them as I go along. So the first is mixed investments, 0 to 35% shares. The second is mixed investments, 20 to 60% shares. The third is mixed investments, 40 to 85% shares. And then the last one is flexible investments. So let's explain these. A mixed investment category, as the name suggests, means that these funds are diversified. And we talked about diversification in our last video. So they can include shares, bonds, property, cash, commodities such as oil and gold, and even derivatives. So by including these different types of assets within the fund, this can provide good diversification and protection if the markets are volatile, which they are invariably over time. The percentage element is the percentage of shares within the fund. The rest makes up the other asset classes, as I've just mentioned. So for example, the fund in the 0 to 35% shares category, that can contain anywhere between 0 and 35% of shares alone. Now, the flexible category is anything goes, guys. It can contain anything from 0% to 100% shares. Anything goes. It's like in Super Mario when he, is it the question mark box when he bashes it and like anything comes out? It could be a flower, it could be a mushroom, any type of asset. Now, which one you choose depends on your risk tolerance, and your risk tolerance is the amount of risk that you're willing to accept. So with that being said, the 0 to 35% category is the least risky, and the 40 to 85% category or above is the most risky, because shares are risky. Next is active versus passive funds. So hands up if anyone has ever had a customer services issue, right? Maybe you've bought something from a store and it wasn't quite what you expected. Maybe it was too big, too small, faulty, or you just weren't feeling it, right? So do you remember the time, and I'm aging myself here, back in the day when you called up the store and speak to a person and they'd listen to you, they'd go through your issue, they're there, it's all right, oh yeah, the customer's always right, and they'll sort out things with you over the phone, person to person, okay? Who's been on a customer services line or web chat recently? Okay, I have. And my issue was resolved by a chatbot, okay? How we love chatbots. Hello, how are you doing, Warren? These automated responses, guys, it's weird. Why have so many companies migrated over to chatbots and away from customer services staff on the end of our phone lines? It gets to me, but anyway, I digress. We're talking about shares and funds here. Why have so many companies migrated away from paid staff to chatbots on the end of their phone lines? Because they're cheaper when you think about it. They can make decisions quicker, they're robots, and they can do a lot more work than a person can. They don't get tired, they don't take toilet breaks, they don't need to take lunch breaks. And if we apply this metaphor to funds, active funds have a human person that makes decisions day to day, week to week, on which specific stocks to buy and sell, and they will make active decisions on what's in the portfolio, and they'll try and beat the market and add value day to day. Now, passive funds are like the chatbot situation. They're slightly different. There's no active human fund manager. They track the market or whatever indices it's set up to track using a computer algorithm. And you've heard me mention in a couple of my previous videos that the FTSE 100 rises over the long term, and it has done since 1986. And also that it's risen 100% or just under 100%, i.e. it's doubled over the last 10 years. Now, if those returns sound good to you, and for me, 10% per year on average is good, guys. Consistent long-term results at that level are hard to find. They're like unicorns. And a passive fund would have delivered those returns to you. If that sounded good to you, you could invest in a fund that simply tracked the FTSE 100 and buys stocks in exactly the same weight or ratio as the FTSE 100. You can buy shares in a passive fund that does this. There's no fund manager, no human intervention in the equation. It's all automated. And it's a lot like with, say, football managers, guys. I'm a football fan, but not all managers are created equal. And it's no different with active fund managers, guys. In fact, stats show that managers, on average, make wrong decisions on stock market picks, just as, if not more often than they get it right. A passive fund removes the risk of picking the wrong fund manager or the right manager picking the wrong stocks. I personally use a mixture of passive and active funds, but for what it's worth, I started out with passive funds only until I was comfortable in my understanding of how stocks and shares work, and then I branched out into actively managed funds also. So how do you find a passive fund? You start with the name of the fund. Passive funds will usually have this identified in their name with words like passive, market, index, or tracker. So be on the lookout, guys, for those specific words when you're looking at funds. You also want to look for where there is a person named as the fund manager. So if it's managed by someone with a posh name or double-barreled name like, I don't know, Hugo Windsor Chestington, that's probably an active fund. If the manager is named as the provider or the team, it's likely to be passive. Okay, so that's the first tip. And I guess that spawns the next question, natural question, which is where can I actually find this information, right? So what you want to do is look at the fact sheet and the key investor document. I strongly recommend using a website called trustnet.com. There's a link in the description below. They are the UK's most comprehensive source of online investment data, news, and research, guys. Linked to active versus passive funds is the cost. Passive funds tend to be cheaper than active funds because you don't need an expensive fund manager to manage them day to day. We're saving a ton in pinstripe suits and swivel chairs and braces, guys. So happy days. Go for a passive fund if you want to save money. And you want to keep an eagle eye on the fund costs because these are a massive factor when it comes to maximizing your returns ultimately, guys. So if the charges are too high on a fund that you've chosen, these will eat into your returns. So shop around for the best deal that you can get, guys. You want to try to achieve a cost of 0.75% or below per annum, guys. I say that that's reasonable. So once you've filtered by category and you've sorted by cost, what you want to look at next is the performance, guys. And we're looking for consistent growth over time. Consistent growth over time. And growth will be shown as a percentage per annum. Next, let's talk about risk, and this is shown as volatility, and volatility will be shown by the standard deviation. So generally speaking, if you're just starting out, the less volatile, the better. So for everybody who got an A in their GCSE maths, hands up, stand up. That's not me, guys. I hated maths. So for all of us in the slow section at the back of the class, in simple terms, volatility manages how widely returns fluctuate from the average. So that's an average, and if it goes like that, that's a volatility. Volatile fund is one where the returns are very much up and down. They're high in one week and low the next week, and it's basically a roller coaster, guys. So avoid volatile funds if you're starting out, I would recommend. What you want is a steady and consistent fund with minimal unexpected up and down fluctuations, guys. That's a keeper. That's the one that you want in your portfolio. No drama, guys. And as I said, you can tell this by a metric called the standard deviation. The lower the standard deviation, the better, guys. The less risky and volatile the fund is. So just to play that out, if we had two funds with exactly the same growth over the same period, say it's 10% each, and we placed them side by side, and one had a lower standard deviation than the other, guys, you should be going for the one with the lower standard deviation every time. Why? Because you can get the same return by taking less risk with your money. Do you get that? So the returns are both 10%, but there's going to be less risk involved with your money. So go for the one with the lowest standard deviation every time. You may also have the choice of accumulation or income units. As a rule, when you're trying to build your wealth, opt for the accumulation units, which are abbreviated ACC usually. And with these, guys, basically any income earned is automatically reinvested within the fund, so it raises the value of your investment over time. You're not drawing those returns out. Whereas income units pay any dividends to you that are earned over the period. With accumulation, it just reinvests it. And I personally do that because I'm building my wealth right now at this moment in time. Now, depending on the platform, we're going to go into this one next week on how to choose a platform, but you want to also choose the share class. So these can be Class A, Class B, Class C, Class Z, institutional class, etc. And the purpose of these share classes is basically to give different rights to the holder of that particular class of shares. So generally speaking, you just want to choose the share class with the lowest fees. Yeah, we said costs were important. Just choose a share class with the lowest fees, guys. And then lastly, but not least, choose one, guys. Generally, you can't go too far wrong, okay, with multi-asset funds. So don't get too tied up with over-analysis. I know I gave a lot of information, but it's very important that you do that. But by the time you get to the end of it, just choose one, guys, and then review it, I'd say every 6 months, just to check on its performance. Every 6 months is a reasonable amount of time, but you really want to give it a good 1 to 2 years, guys, before you start heavily scrutinizing its performance, guys. It needs time to do its work and benefit from compounding over time. Funds are like wine, guys. They need a good period of time to do their best work and perform and come good, right? So this is not a short-term speculative video, guys. This isn't day-to-day or intraday stock market trading. We're all about long-term consistent growth over here. There's no shortcuts. At least I haven't found any yet. And that's it, guys. I hope you found this video useful. Please do consider liking, sharing, Please do consider liking, sharing, and subscribing, and I'll see you guys next week.